You ready? Gosh, I'm ready. Let's go. Let's boogie. Let's do this, people. Thank you all for being here. I'm excited. I'm energetic. I am ready to go. I just want to let you all know there's two ways how we can look at this entire thing called AI. We can either think of it, this whole thing is going to burn down to the ground. We might as well make a bonfire out of it, or we can make it all turn what we want it to do. Okay, whatever it is, to me, let's make it a positive outcome. Okay, no need. I see too many people, the drama and stuff like that. I've been too many times here, too often. It will all be okay. So I would not. We'll make it work. How about that? We're just going to make it work. Today, I'm going to take you through, like something that I want to talk about, that I'm passionate about, and it's called unstoppable growth. Now, I'm going to share my deck, not in presentation mode, because I want to navigate. I want to take you through things. I want to take you on the journey that I want you to enjoy the whole content, and that can cherry pick and take myself on the road with you. Now, I am going to be taking a look at the notes. So if you have questions, we got a team here, ask questions, right? Like I am here, ask questions. I am here right for you to go for it, and we'll take it any direction that we want. First and foremost, in order to make sure that my team sets me free, because otherwise I have to keep forgetting that, we have this Impact Summit coming up on May 12th. A few tickets left. Over, I would say, about 130, 140 people right now, mostly CEOs, CROs, CMOs, and so on. Like a lot of well-known people. If you want to attend, tell my team to send you the lookbook, and you can get an idea of who's attending and so on and so forth. But making sure that if you come, you're welcome to bring a person. We recommend everybody to come in twos. Bring your CFO is a common thing. Okay. That's it. Look at that thing one more time. I have fulfilled my obligations. I am ready to go and to talk and do for the next 45, whatever time we have to go. Talk to you about where the future is at. Okay, take a look at this. What does this mean to you? Type in the box here on the right, chat box. Here you go. What do you think this means? SaaS is dead. What do you mean? Help me out here. Jackie, I know you will start us off, but Derek, like these are all people that we know and love. So people that I know and love, type in the chat box. What does it mean? SaaS is dead. Tell me, talk to me, chat it, put it in the chat box. Okay. I'm waiting. SaaS is dead. What does it mean? Am I in the right chat box? Can you all hear me? There we go. Everybody can build. Okay, I love that. Jeremy, love it. Obviously, Jeremy, first one to comment and first one to show up. Why am I not surprised? David, SaaS is changing, a new word. Okay, here we go. Room for improvement. Love that, Lauren. Okay, these are things. We're going. Good. Growth at all costs is no longer. Fantastic. While you keep typing, I'm going to show up the slide that what industries are talking about. What do we mean with SaaS is that? Here, Satya, Naval, Ewan McCabe, which we talk a little bit about today, Parker Conrad. Look at this. Everybody has a different opinion what it's that. And when is that, and and what and why and how. Look, I don't think it matters. I think what matters is like where are we going in the market and how are we doing that? I think that from a customer perspective, whether it's SaaS, whether it's AI, whether it's AI with a SaaS application, a business model, where it's SaaS with an AI edge to it. I think that our customers are not changing. Our customers still want impact delivered, and they want to willing to pay for it. As simple as that. Now, they may want it in a different pricing model or pricing structure, but everybody just is willing to pay. That's not a problem. They're just unwilling to pay for things that they're no longer getting. And I think that is a very fair statement. Now, as a result, some customers will run a subscription model, or some people will buy from a subscription model. Some people will buy from a consumption model. Here's, but going back to these foundations and fundamentals, that's what we're here to talk about today. And I'm going to go hyper fast. Charlie, good to see you. I see you there on the chat box. Good to see you. Yasmin, also great to see you. So what I'm going to take you through is I'm going to take you through these three steps here that are in front of you, and I'm going to step through it relatively fast, knowing that you can always subscribe to content or transcribe the content and let it play back. So, what's the shift that is happening? Number one thing, I don't want to dally too long on it. We all know Benchites, and my David Spitz, my friend at Benchite, has presented this tremendously and well and over the longest period. Here's this new product demonstrated. But essentially, what it says is the growth rate has dropped across public SaaS companies from 34% to 15% and is stabilizing around at 15%. What that means, people, growth follows an S-curve. The entire SaaS market follows an S-curve. And what this means is that this entire SaaS market has gone from a hyper-growth growth curve to a flattening part in the S-curve. That's all what it means. What that also means is that where we thought when we placed investments in 2020, 2021, and where we are now, that is the problem. And so the major thing that is what we can say is dead, rather than the different assumptions, what we know for sure is that the valuations are no longer what they were on SaaS companies. Why? Because the growth rate is down. Now, how did that growth rate come down? I want to make sure, stop share screen, add audio, share sound. I got that. All this is going. Boom, boom, boom. I'm going to play this little video. Many of you may know it. I'm just going to play it shortly, and I want you to let it sink in what is being said, okay? And let's see what happens here.
So, what you're telling me is that the music is about to stop, and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism.
Sir, I'm not sure that I would put it that way, but let me clarify, using your analogy, what this model shows is the music, so to speak, just slowing. If the music were to stop, as you put it, then this model wouldn't be even close to that scenario. It would be considerably worse.
Ladies and gentlemen, that is what we're experiencing. The model has started to slow down. Had it stopped, it would have been significantly worse. I'm here to describe to you today what is happening and how that could work, okay? So, next thing I want to talk about, technology lifecycle. I'm going to go, as you can tell, to these 5 points. Every technology that has come before us has gone through a cycle. That cycle is remarkably similar. And whether that is the automobile, the airline, or the railroads, whoever replaced whomever, used this approximate technology cycle that takes about 10 years for the technology to go through explosive growth, and then it declines. Okay, that is a common trend. We can overlay web and mobile, and you'll see a remarkably similar trend. We can overlay even what we see SaaS, and we see a remarkably similar trend. Now, we could argue that SaaS is slightly delayed compared to web and mobile. That's primarily because COVID extended its life cycle due to a once in a lifetime what's referred to as a black swan event. What we can also see is AI is now in its explosive growth mode and meeting its expected demands of fast growth in that stage. We often say we have never seen this growth before. We have. We just haven't seen it in B2B to this extent and to this volume, but companies have grown like this before very fast, and in particular cycles. This is not the first market that sees a company grow to $1 billion in a couple of years. And I think that in many cases, we can look at other less favorable industries, arms and gambling, that have seen a similar rise. Okay, so what we see here is that we're on this cycle, okay? This cycle means that SaaS as a technology peaked in about 2021-22, and that it is now entering consolidation. Okay, it's entering that market. Now, how fast we decline, we don't know. On one hand, we think that AI will replace it very fast. On the other side, we see that the tempering element of it, SaaS is hard to kill as a business. And I know that many of you know SaaS businesses that really should have no right to exist, still exist, because the model of retention over years is so hard to decline. Okay, what we also can say is that AI emerged in 2022 and it is now in explosive growth mode. This is not like, oh, should we debate about this? These are simple things that are happening and that tell us that this is a recognizable pattern. It has happened before and it's simply happening again, and what we can expect and why we should expect that. What we then look at is like, hey, if I look at this picture, how the mobile replaced web, or if I go further, how cars replaced the horse industry, I can take a look and say like, hey, what is this stack? Now I'm going to already put both stacks up so that we can, because many of you may want to take a screenshot of some sort. So welcome that. But what you'll see down here is the stack on the left is really the stack that tells us all about like how SaaS build, right? At the bottom, we have an Intel-based CPU infrastructure based on connectivity and storage. When you buy that from a company like AWS, you will see it's called E3 and EC3 and D3, but essentially we're buying storage, compute power, and connectivity. That's what you do. Then you have your data interface layer that sits on top of those providers. And in order to access that data, you have multi-tenancy. Multiple people are sitting on the same server, going over the same CPU processor and using the same memory. And in order to protect data from spilling over, we need a technology or a development called multi-tenancy and a governance to make sure that that doesn't happen. And if that happens, that somebody's held accountable. On top of that, we access this. You do this every day. When you log into your Zoom, you use a single sign-on. That's a form of authentication. You do the same thing with your fingerprint when you pay on any one of your devices. That is all access to the forms of APIs, which is just a way of accessing content. And on top of that, we run our dashboards and workflows. That is the SaaS stack. The problem is, and I want everybody to realize, the reason why we go through that from blue to purple is not because of just a subscription-based model. It is because the infrastructure underneath it, that this entire AI infrastructure is built on, the AI stack, is an entirely different stack. That stack can run on SaaS, but it wouldn't do anything powerful. In order for AI to be powerful, it needs to run on this dedicated stack, which is a very different stack. Where SaaS was all commodity-based, the AI stack is very purpose-built, is very dedicated. And so we talk now subtly not about, like in SaaS, we don't talk about which servers and which infrastructure. Is it using a Dell server? Is it using an XYZ server? Well, what you'll see in the AI stack, we talk about, is it CoreWeave? Is it Lambda? Is it XAI? What is the infrastructure of what it's built on? It's dedicated AI system. On top of that, you see, the training models and the inference cost, which is the AI processing. And on top of that, you have nowadays, many of these terms may still feel uncomfortable, but within a few years, RAG, MCP, memory, and new terms will become as knowledgeable. We all become as knowledgeable as it is about single sign-on and payment and whatnot. And on top of that, we have the intelligence models, whether it is from OpenAI or Claude or whatever it is, you'll see the models named there, Opus 2.7 or ChatGPT X.4.6, whatever it is, that sits all on top of that, right? This infrastructure, primary thing is, this on the right is not like 1 times faster or 2 times faster, not even 1 dimension faster, we are talking about an order of magnitude 2 to 3 times faster. That means it's 100 times to 1,000 times faster. That is super important. This system runs on such a higher velocity, different stack, different physics, and that means that we also have to look at different economics. Now, let me be honest. The car was not kind to the horse, the car industry. It replaced it. Right? So let's be honest, generally new technology replaces other technology, and should be no surprise that within a few years, AI will do to SaaS what SaaS did to like perpetual software from years ago, right? The software that you would put on disk and so on. What is also important is that, you cannot run a solidified AI business on a SaaS stack. We need to understand there's limitations on that chassis that it is capable of. Now, as a result, and I'll only briefly talk about this because this is a very thing that fluctuates a lot. What we see that capital is migrating, which is really where the needle sits. Where we previously see like how many billions of dollars were spent in how many years through government sovereign-based capital. We now see, we just saw the news a few weeks ago that NVIDIA gets a $1 trillion order from China, which I thought was debatable if America would ever allow that. But lo and behold, we put a 25% tariff on that and it got approved. So these things of from like, hey, how is the technology growing, and who is driving what's the money behind it. We're no longer just having venture capital money or private equity money. We're now having nation state money that is being put into the development of this. And that is a significant migration, causing a migration from where we said previously is invested in SaaS and is now invested in AI. Right. And that migration is putting tension on our infrastructure, on our ecosystem in multiple ways. That is where a lot of this tension is coming from. Now, in that, there is this story, and a fantastic story by Ewan McGabe, and the founder of Intercom. And the story, it's not all roses and sunshine. There's a couple of things we need to talk about. But a few weeks ago, March 2nd, let me change that. What is that? 5 weeks ago. 5 weeks ago, is it about 5 or is it more even? Make it 7. We just put a number up there. 7 weeks ago, Ewan came out and on LinkedIn came out of an article that gave insight to what he was doing. And in this, he was sharing this particular picture. What we see down here, and let me just delete that verse in a second. I'll put it back. Ian, any questions I should address? Are we good?
I think you're good. Yeah.
Right, good. And so I'm going to take this out a little bit down here. And so again, this was 7 weeks ago. You now know where this was. But what you see down here, look at that blue first bubble over there on the left, right? Like that is the decline of the SaaS market, right? That is what we see. When I go back earlier, that essentially is what David Spitz saw in the public SaaS markets, right? And Intercom being there. But what we also see is that happens into most companies. Probably the reason why many of you are here, you're part of a company and you see this rapid decline in growth rate, right? And then, Ewan came in and he was the member of the board, and he took back the company, and right in there where he put shock into it and changed the company. Now what did he do? He created a new mindset, and nowadays the term for this is that he has refounded the company. Right, refounding the company is taking it back down to the studs and looking at it and figure out what works and what doesn't. He saw the opportunity late 2022 to early 2023 as a new opportunity. Fortunately, he already had an in-house AI team. He switched to outcome-based pricing from a subscription-based pricing, thereby cannibalizing, as the article goes, $60 to $80 million in revenue. But he had 30,000 customers to use that on. So he could cannibalize and immediately redeploy to re-kick the engine, the growth engine. That is significant, right? To see that. Now, note that we could argue, and again, this is from the perspective of a Monday morning quarterback and going woulda, coulda, shoulda. Yeah, fantastic. You have to put this in context of his time when he did it. That was a remarkable decision to make. From a spreadsheet perspective, we would argue we could have done it in the blue zone and didn't have to wait to the red zone. But again, you have to put this in context and the human in the arena kind of perspective, and do nothing but make it respectful that he did that and how he did that. That was a founder-dependent choice. Not every company has a founder on the board who is really ready, able to go back in and tackle that problem. Not every founder is willing to burn the ships in the process. That does require a hard turn. You cannot make that democracy based. When you gotta go, you gotta go. It's go, 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 and that caused the consequential turnover. We could argue whether in today's world and the luxury that we live in, if that's the right decision. I can tell you, considering the results, that seemed to be a fantastic outcome, right? Look at here. Since then, the revenue has shot back up, right? And that is kind of like what we wanted to point out is hey, there are positive effects in that it costs. Now, his article said there's exactly only one way that SaaS can be saved. I have no problem with that, other than it's not the only way. It's the only way when it's that late. And so when it's that late, I think there are other ways. And what I'm particularly pointing out is there's a way there in that blue zone that we can take action in order to make that happen. Right now, I want to draw your attention, and I'm going to delete all these things for a second. Okay, I want you to take a look, and I want you to see what I see. That black line is the David Spitz decline of the market. The blue line essentially is two bubbles. Look at it. Two things. It's not the same thing. These are two different things. Same line, same company, two different products, two entire different things. That's what I want to point out to you. That on the left, that is the decline of the SaaS innovation. That on the right, and that's what we said, SaaS is entering consolidation mode. That on the right is the growth mode. And again, I'm going to bring that up so we can see the clear comparison. That is going down. That is going up. That is connecting the dots. And so now what we see, really what we in a second are going to talk about and what we were going to discuss at nauseum over at the conference in San Francisco on May 12th, this is the topic. Can I jump from the SaaS level approach to this, and preferably without having to put, like the entire system in shock, right? Like that is what can we do that by avoiding that or minimizing the effect of that? Or, because not everybody has a founder capable person. Not everybody has what they had, right? That's the point. That's the shift. That shift we call unstoppable growth. Now, the plan is relatively simple. Right? Like I'm going to take you through what the plan looks like so that we go like, okay, I understand that this shift is the case. How would we do that? Okay. That is called unstoppable growth. Let me take you through it. I'm going to give you like a few seconds to read this out in your head. Please read this for the time being. Give it a second. And meanwhile, I'm going to check comments quickly. Yes, and Apple cannibalized the iPod for the iPhone, Charlie. Fantastic point. Exactly. Well said. Thank you for the comment. John Glover, why not Vibe Code and Enterprise CM Code? Okay, good comment. We're simply stuck. Yes, we're stuck in classical Tinkle for all GTM. Granted, yes. Okay, as you now have read this, what is unstoppable growth, right? Unstoppable is how do we jump? And Charlie mentioned it already a second ago. Apple, when it cannibalized the iPod, it essentially is a way of calling stacking S-curves, right? Now, I want you to look at this chart and remember, SaaS is on the growing S-curve and it's flattening, and then AI is starting, right? Now, where does growth stop? Look at this picture. And if you could put your finger on it, right? Like where did growth stop? It's a clear signal where it stopped. You see it? Okay. If you see it, that is where growth stopped. Now, what is unstoppable growth? I'm not going to make this complicated, people, right? Like listen to this. What is unstoppable growth? And in order for Ian to make that thing happen over there, what you see, he had to put the AED on it, right? Like, that is unstoppable growth. What if I overlap them? This stacking of the S-curve is not a new thing. It's a well-known thing. It's deployed. It's the reason why Apple keeps growing, welcoming its new CEO this week, right? But it's like how the iPod became the iPhone became the iPad, all sitting on top of the computer series, and nowadays the consumables driving their growth, right? Like that, it's stacking S-curve. Right? That stacking the S-curve is essentially what you'll see down here, and that's what we want. Now, there's two approaches to this. That one is called intervention. That one is intervention. That is interception. You either have to create an intervention or an interception. It would be much nicer if you could do an interception. How does an interception work? An interception means that by the time I see my growth rate go down, let me go back to Ewan's picture down here in that blue thing that we saw. By the time I see it go down here in the blue, I need to know how far it's going down, how fast it's going down, and so on. And as you see, this happened in case of Intercom in about 8 quarters. From afar nowadays, that is likely to see, but when you're in the mid of it, and many of you that have executive positions know it, you're in the middle of it, but the pipeline is thin, the sellers are not selling, you're blaming everybody. So by the time it's too late, you're in the red zone, you've stopped blaming everybody, right? But the way to learn and to figure out how to do that, you got to learn how to plan your growth. And so what I'm going to show you is how growth planning works. Okay, let's do growth planning. And so growth planning works as follows. Look at these 2 lines. These are 2 growth lines, the white and the blue. The white line is on target, and that dot at the top means that's the target for the year end of 2026. The blue line shows an organization that misses the target. Now, if you're the CRO, the VP of sales, and I go like, which of these lines do you like better? Many of you would answer for completely viable reasons. I like that white line a lot better than the blue line. It's stable, it's dependable, it's even predictable, and it gets me on target. Unfortunately, when you're taking on money and funding, you're not just based on this end year's goal, you have to also address your thesis, which is a long-term goal. So let's put that longer-term goal in 2027. It's not very long, but it's slightly longer. And what you now see is that what looked linear was actually a linear decline, was a slight decline that caused the current trajectory not to hit the goal. And essentially what that blue line was, when we zoomed out, we saw that was a compound growth line. That's the concept. What we are doing today with many SaaS business models is that we are essentially cannibalizing the compound engine in order and in an effort to make this year's number. Now, this year's number is important, but that compound engine is also important. Both are important, because if I don't hit my investment thesis, that is a problem. And for many investors, they go like, whether it's, and this is in case it's growth, it could also be an investment thesis. We could draw this similarly. If it's PE, it would be profit centric, right? Or EBIT centric. And so like what we now need to think about growth planning, we understand our growth is constrained. We realize that, right? We know that buying more growth is cost prohibitive. Many of us are today buying growth. We're using SDRs, AEs, CSMs, outbound campaigns, but essentially at the premium dollar, we're buying growth, causing that the client acquisition costs now start to have a negative impact on the overall LTV cost. In other words, it costs us way more. We never recoup that over the reduced LTV that we're experiencing. This complexity that we are now in the market, we are experiencing, is often driven by systems, no longer by people behavior. And those systems have a compound nature. Compound meaning it requires time. And in most experiences, the human beings that are driving these machines no longer have the natural intuition to do that, coming out of an intuition that is built of 15 years on how to drive a people-based linear machine. Now, they created exponential growth, I can hear you think, but the way we created exponential growth via a linear machine was primarily by hiring resources at an exponential level, right? And on top of that, right now, capital has become selective. And as I said earlier, that capital is now moving to AI. This is the reason why we now need to start growth planning. And I'm going to take you through what that growth planning looks like, because I need to find that interception point. I now understand that my growth is constrained, that I can't trust my regular intuition. Oh, just hire more salespeople, launch more a campaign. What thing can I do? Open up another event. All these things, which we refer to as reasoning by analogy, is no longer helping us achieve our goal. We have tried it all. That's the reason why everybody is so fatigued. We're all tired because we keep trying the same thing that we do to the best of our ability, and we're unable to get out of it and what the machine used to deliver. This is where growth planning comes in, okay? And so here's how growth planning works. Historically, when we run this number, and I see this, like with organizations, right? They run off a single outcome-based number. What is the number we're going for? We're going for $12 million of growth this quarter, this month, this year, whatever it is. We're going for $180 million growth. I go like, okay, what's the probability you're going to hit that? Most people, when they then state a probability, it is something like 80% or 60%. And these are gut feel numbers that they're looking at their numbers, and a good CRO, a good revenue leader will look at these numbers and go like, based on my experience, right? It is that. Let me take a look back. Based on my experience says, I am about to trust your intuition. And as many of you have now experienced over the past year, the intuition no longer is right because we are living in a new market. And so what we're doing today, and what is our market unfortunately known for, is we are still, and I say it out loud, we're still an amateur market that is in which we are getting paid professional salaries. Every other professional market thinks in probabilities. If you think in the medical sector, it thinks about probabilities, not yes, no, hot, cold, probabilities. And probability gives us a range of things. This is something we are very unfamiliar with in the opportunistic world, because we were far too long dependent on sales capacity. There was plenty of opportunity out there. There were plenty of people who wanted SaaS, and there were plenty of new SaaS companies who helped us create more market. And as a group of 50,000 companies, we created a market for another 10,000 companies. And it created a form of an incestuous growth, right? And so in that world, we didn't need probabilities. All you needed to do is hire more salespeople, deploy more marketing campaigns, throw up more events, spend more on SEO in order to acquire users, and so on and so forth, including PLG, right? But in this case, we now need to start learning how to properly forecast in forms of ranges, which AI gives us also the tool to. And what we see down here is if we project this, we can now run scenarios. And again, we're demonstrating this at the Impact Summit, and we can run scenarios, proper scenario analysis that shows if you invest in this, the most likely outcome is between this percentage and that percentage. And it shows you how we're moving this over time and why we should make that investment. Now, why is that? Remember a second ago, I told you that blue line is a compound line. So maybe we should, move some of our investments of the linear growth methods to these compound growth methods. For example, there are known compound methods, right? We know viral. Oh, viral is good. Viral is fantastic. You know what's even better than viral? Getting your users to promote what you're doing. You know what's even better if you have enterprise customers? Getting your existing customers to buy more from you, to deploy to larger parts of the organization. Right? Like this retention thing actually is the entire engine it runs on. And if we start investing in that machine instead of in linear growth machinery, you can see we can start bending the growth curve, right? And that bending the growth curve now see that we get a chance of success. For those of you who are statisticians or, have a background in data or mathematics, you go like, Jacco, that's not really what we want. This is really what we want, and I would agree. We really want that cone to be as narrow as possible. I get that, but I would be already happy here because we're on the board with 10% down here, and we have often the displeasure of taking many boards and CEOs through this conversation. Your current chance of hitting success, not only on this thesis, but also on this year, are 0%. Okay, we at least are now on the board for this year, and at least we look good for we're at least on the board for hitting our thesis, right? Okay, now how this works is I'm going to take you through. There's three things that you need, people. That like you can't say, oh, I'm going to use we're going to keep looking at the funnel. No, you're going to need some element called revenue architecture. Many of you on this call have gone through the course. You can't look at just the acquisition part of the funnel. That's not where compounding takes place. Compounding really takes place on what follows after a customer has committed to it, that when they're happy. Again, no surprise. If you thought I was going to be highly surprised about this content of this session today, I'm sorry. I'm just trying to convince everybody this is how this machine works. Then today with AI, we're now giving these dramatic new financial tools that can operate on this revenue architecture. Now, this revenue architecture today really is a much faster growing real-time database than the past. So on this revenue architecture, I got really high velocity data. I can now deploy tools that can make complex calculations in a matter of seconds or minutes, which allows me to make, perform scenario analysis. That scenario analysis, I'm just going to give you a little taste of it. It's like a little bit like menu tasting, sampling, right? Like drink this wine, taste this thing. Here's an indication of how, for example, a probability-based forecast looks like. And it tells here on the left that we have about 10% likelihood of hitting 50. Sorry, they have a 90% likelihood of 52. Folks, do not blame me. It says P10. In probabilistic terms, P10 equals 90%. It's the reverse. Not for today. I'll explain it another day. P25 means that 75% chance that we're going to hit that $53 million. 50% chance that we're going to hit, I need to put my glasses on, $54 million, and 90% chance we're going to hit $56 million, right? And so the point is like we can now calculate this out, and so that when a person reports the progress, hey, how does this quarter look like? It's not like, oh, we're looking good, we're looking for 3x the funnel size, we're dependent on this big deal, right? Like that may all be true. This is the mathematical way how professional CROs, either today already, but within a year to 2 years, will be operating. This is what you report. You don't report a single number and saying we're going to miss it or we're going to hit it. It's all about probability-based forecast. Now, what this also allows to is it allows you to go into each GTM motion right now and create what we call a 3x3 in this case. I have 3 GTM motions, look at that, SMB, enterprise, and government in this case. And I got 3 different sources of revenue, acquisition, retention, and expansion. That creates this 3x3. Don't overthink this 3x3. All this tells me is where is the biggest gap right now cost, and it shows like, okay, that big blue block's over there. That's a big risk. We're about to lose out of $85 million. We're losing or we're short $70 million out of SMB, and out of that we're short $50 million out of retention, right? Like we know this because we know how the number, your machine has built up to this point. That allows us to create new scenarios. What if we do X? What if we do Y? Now, what I want to point you to, in order to get you, and I know I'm going fast. Several of you will go like, what the heck is this? Again, welcome. Yeah, like this level of insight, we go way more deeper later on and more sessions. All this is setting the stage of what is possible that AI is making all of giving tools that it's giving all of us available today in Claude is opening up this world that allows for pinpointing where we're going to deploy our resources. Because I can tell you, if we deploy our resources on that blue box over there, let's make it red because I'm in mode. Let's make it red. Okay, that blue thing. Oh, that thing over there, like that thing. That's what we need to solve. That's where the risk is and where the opportunity is. I can also see, the biggest opportunity comes out of $3.9 million in retention for government, right? That there's an opportunity to fix that, or what's the 6.9 come from? 2.3, there's another big opportunity. And so what we see is that like, where's the opportunity to grow and where is the risk? We can now deploy our resources. Now, here's the thing, and I'm going to run this by you folks understandably, okay? PLG users, their primary compound growth engine is bringing on new pre-LG users, more users, right? So if I'm Canva, the fastest growth possible is members of a Canva team or people who experience Canva to go online, creating a great experience and telling others about it. Or nowadays, Claude Design and so on and so forth. The quickest way of growing is users that bring on other users. That's PLG. That means that it's very advocacy-centric driven growth. SMB, and also hype. SMB, its growth primarily is, as you can see down here, is constrained by retention. Enterprise, its compound growth engine primarily comes from expansion. These are different growth compound. They have different behavior. So if I have to hit this huge target in 2030, I can't just say I'm going to treat the entire machinery of my company as the same compound machinery. I'm splitting this machinery up in these 3 engines who have different compound behavior, over time, and that creates this mapping over time. What do I need to do in this year? What do I do to next year and following year? Taking into account that accounts that I win this year need to be, in SMB case, retained next year. And in enterprise need to help me, help grow expansion. And in government, I need to make sure that I, in this case, retention again, right? Like this engine in this particular case of this particular customer tells me by year, how do I need to switch gears to hit the target, right? And again, I'm going to share this little thing here, right? Like as we are in trouble right now, right? There's a solution to this. And let's see what Matt Damon has to say about this.
At some point, everything's going to go south on you. Everything's going to go south, and you're going to say, this is it. This is how I end. Now, you can either accept that, or you can get to work. That's all it is. You just begin. You do the math. You solve one problem, then you solve the next one, and then the next. And if you solve enough problems, you get to come home.
And that is the problem that that is the solution I'm advocating for today. Today, when we want to test out the market, we're deploying all the resources on that market and we say, go, 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 we commit to it. Folks, with the AI tools that are being given us, and in many cases subsidized by governmental, grants of measured in the billions of trillions of dollars, can we use those tools and just do the math? Can we just start learning how to calculate what is the probability? Where is the growth really coming from? Which campaigns do I deploy? What's the short-term and long-term impact? Folks, that is what we call growth architecture, the proper architecture of growth over the next periods of time. Yes, if you are on a rocket ship and you're taking off from $1 to $10 million, by no means do not do too many calculations. Go, 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 go. I get that. But if you're $120 million unicorn, valued as a unicorn, you see your growth rate go down, I can also tell you, your go, go, go mentality, hiring more people ain't going to get you there. Somebody needs to go do the math and deploy well available resources at the areas where they're causing the biggest leverage in order to grow. That's the concept of growth architecture. That's the concept of the growth summit, the impact summit we're organizing, which essentially says to you folks, and folks, and again, I'm bringing that slide up. Where did I have it? But that says to me is like, hey, we need to come to the impact summit if you want to learn more about that. Okay, having said that and wrapping it all up, a little bit behind time, but with the energy, I'm thinking like this. Okay, what is the action you can take? I want you to ask these two simple questions to yourself and of the organization. What is the target that we go for by this quarter, this month, this year, by this investment cycle, whatever it is? Can you answer the question what the probability is that we will hit that? Because if you can't, you'll most likely find yourself in a single outcome-based company. And a single outcome-based company, you either hit or you miss, and the likelihood of you missing it is big, right? We don't want that. Now, that is what I'm here to talk to you about. That was what I was here to tell you about over these past minutes. I'm quickly looking up and to see if there are questions in the chat. Bring up any questions in the chat. I love Scott Ingram, do the math. Thank you, Bob Apollo. Oh, shoot, you were just, Bob, where were you? Which revenue stream and which customer segments are inherently compoundable? Bob, fantastic question. Every engine has a different compound behavior. And primarily, Bob, the time factor is different. And so as you would expect, PLG runs much faster, and so therefore it compounds faster. But we also know that PLG doesn't expand. A single user doesn't expand that easily. A single user doesn't go from, hey, I'm spending $1,000 a year to let me go spend $5,000 a year. So a single user's only compound behavior is bringing on other single users, right? Like other what do you call pro users? If you think, and that's the reason why that works different. And so now, what many SaaS companies are experiencing, Bob, is that they are given an opportunity to up-level their price. And so our analysis shows that on average, today, companies can increase their SaaS companies with a SaaS-based licensing model can increase the revenue of an account by approximately anywhere between 5 to 8% by selling off AI-based features at a premium. Now, whether that is in a consumption-based model at an increased license or on an outcome base is to be determined about what your company is and how long it takes to get those results. An advanced software protection program that only has an outcome of one successful protection every 3 years, but it saves the company, cannot be the same outcome based as a Canva, which produces, successful products every 30 seconds or something like that, right? I'm making a point. It's not a good, but I'm making a point. I'm not necessarily making it eloquently. But that's the way of thinking. You got to think is like, how does this specific compound engine compounds? That was not the sentence I was thinking I was going to say this morning. How does this compound engine compound? Yeah, that's good. I think it's good. That's the thoughts. With that said, I want to hand it back to Ian. I want to thank you all for coming. Thank you very much for having us. We hope that we tested out today by welcoming all the recorders and the transcribers, knowing that often I go fast and that it takes a little, that it is of great help to engage with this content later on through your AI of choice. With that all, thank you very much for having me. Have a fantastic week. Looking forward to see you on May 12th if you're going to be there. And yes, have a great day. Have a great week. Rest of the week. Thank you all for being here. Bye-bye. Path to the math. I love it, Danny Yoko. I love that. Path to the math. That's it. Path to the math. Okay, that's the close I'm going to go on. Path to the math. See you all. Have a fantastic